Imagine waking up one morning to headlines saying global stock markets are frozen, banks are limiting withdrawals, currencies are swinging wildly, and the shockwave didn't start in New York or London, but thousands of miles away in China. This isn't a movie plot or a doomsday fantasy. It's a slow-building financial reality that has been forming for years, mostly out of sight, and it revolves around an estimated $8 trillion of stress buried deep inside the Chinese economic system. Stress that could unravel far beyond its borders and pull Western markets down with it if the wrong threads snap at the wrong time. China's $8 trillion crisis isn't a single bill that suddenly comes due, and that's what makes it so dangerous. It's spread across property developers drowning in debt, local governments propped up by land sales that no longer work, shadow banking products promising returns that can't be delivered, and a financial system that relies heavily on confidence staying intact. To understand why this matters to Western markets, you have to picture China not as a distant, isolated economy, but as one of the main load-bearing pillars of the global financial structure. When one pillar weakens, the weight doesn't disappear, it shifts, and often it shifts violently. Over the past 3 decades, China became the world's manufacturing engine, the largest consumer of raw materials, and a critical buyer of Western debt and corporate output. The crisis brewing now is the result of a growth model built on borrowing today to promise prosperity tomorrow, with real estate as the centerpiece. At its peak, property and related industries accounted for close to 30% of China's GDP, a staggering concentration when you consider that homes were treated not just as places to live, but as the primary savings vehicle for hundreds of millions of families. The $8 trillion figure comes from combining multiple layers of obligation. There's roughly $3 trillion in direct property developer liabilities, led by names that once seemed untouchable, companies that borrowed aggressively assuming prices would always rise. Add to that local government financing vehicles, which many analysts estimate at another $3 to $4 trillion in hidden or semi-hidden debt. These entities borrowed to build infrastructure and services, counting on land sales to repay loans. When property sales collapsed, that repayment engine stalled. Then there's the shadow banking system, wealth management products sold to ordinary citizens with the promise of safe, steady returns, often quietly linked to property projects. These obligations don't always appear on official balance sheets, but they still represent real promises to real people. When you tally it all, you arrive at a stress load approaching $8 trillion, an amount so large that even modest losses can cascade through the system. Now ask yourself a simple question. What happens when confidence breaks in a system built on confidence? In China, many investors believed the government would never allow large failures, that the system would always be backstopped. But as property giants began missing payments and projects stalled, that belief started to crack. For Chinese households, this wasn't an abstract market event. It meant unfinished apartments, life savings locked into assets that couldn't be sold, and the unsettling realization that growth was no longer guaranteed. When people stop spending and start hoarding cash, economic momentum slows. When that slowdown hits the world's second-largest economy, the effects don't stay contained. Western markets are tightly connected to China in ways many everyday investors underestimate. Start with trade. Europe and the United States export hundreds of billions of dollars worth of goods to China each year, from machinery and luxury items to agricultural products and advanced technology components. A prolonged Chinese slowdown reduces demand for these exports, directly hitting revenues and profits of Western corporations. Lower profits mean lower stock prices, weaker earnings reports, and reduced investment. Then consider commodities. China consumes more than half of the world's iron ore, copper, and a significant share of energy resources. When Chinese construction and manufacturing slow, commodity prices fall. That might sound good for consumers, but it devastates commodity-producing economies and companies, many of which are listed on Western exchanges or tied into Western credit markets. The financial linkages are even more complex. Western banks, asset managers, and pension funds have exposure to Chinese debt, equities, and joint ventures. Even when direct exposure seems limited, indirect exposure can be massive. If a European bank lends to a multinational company that depends on Chinese sales, that bank is effectively exposed to China. If a U.S. pension fund holds shares in a glob, index fund, it likely holds companies whose growth assumptions include continued Chinese expansion. When those assumptions fail, asset prices adjust downward, sometimes abruptly. Markets hate uncertainty more than bad news, and the opaque nature of China's financial system amplifies fear. Investors struggle to assess who holds the losses, who might be next, and how far the damage spreads. History offers uncomfortable parallels. In 2008, the U.S. housing crisis seemed at first like a contained problem, a niche issue in subprime mortgages, but those mortgages were sliced, packaged, and distributed across the global financial system. When defaults rose, trust evaporated, credit froze, and a localized problem became a global meltdown. China's situation is different in structure but similar in psychology. A debt-driven boom meets reality, leverage works in reverse, and the belief that authorities can control everything is tested. The difference is scale. China's economy is larger relative to the world today than the US economy was in 2008, and its demand footprint is enormous. A sharp contraction doesn't just slow growth, it reshapes global trade flows, investment decisions, and currency relationships. Currencies are another pressure point. If China's growth falters significantly, capital seeks safety. Money flows into perceived safe havens like the US dollar, US treasuries, and sometimes gold. A stronger dollar tightens financial conditions globally, especially for EMA, RGing markets and companies that borrowed in dollars. This tightening feeds back into Western markets through lower global growth and higher volatility. At the same time, China may allow its currency to weaken to support exports, which can trigger competitive devaluations and trade tensions. These currency moves ripple through bond markets, equity valuations, and corporate balance sheets worldwide. Precious metals provide a useful lens here. Gold is often described as financial insurance, not because it produces income, but because it tends to hold value when trust in paper assets wavers. During periods of systemic stress, investors reprice risk and assets perceived as safe stores of value gain attention. A deepening Chinese crisis could accelerate this dynamic, especially if it coincides with already high Western debt levels and stretched valuations. Silver, often called gold's more volatile cousin, straddles the line between monetary metal and industrial input. A Chinese slowdown can hurt industrial demand, but a global financial shock can boost investment demand, creating complex price behavior that reflects competing forces. The key danger lies not in a single dramatic collapse, but in a prolonged grind that erodes confidence step by step. Missed payments become restructuring talks. Restructuring becomes quiet bailouts. Bailouts strain public finances. Growth slows further. Foreign investors grow cautious. Capital controls tighten. Transparency declines. Each step along may seem manageable, but together they form a feedback loop that steadily increases global risk. Western markets, already sensitive to interest rates, inflation, and geopolitical tension, don't need a perfect storm to fall, just an additional weight pressing on already stretched systems. So when people ask whether China's $8 trillion crisis can really collapse Western markets, the honest answer is that collapse doesn't usually arrive as a single dramatic moment. It arrives as a sequence of shocks, reassessments, and repricings that change how investors view risk itself. Understanding this means looking beyond headlines and focusing on connections, incentives, and human behavior under stress. And it also means recognizing that what happens in one part of the global system never truly stays there because the true transmission mechanism of a crisis like this is not headlines but behavior, and once behavior shifts, markets follow whether policymakers like it or not. In China, households, corporations, and local governments have already begun acting differently, and those changes quietly transmit stress outward. When families stop buying second or third apartments because they no longer believe prices will rise forever, developers lose cash flow. When developers lose cash flow, they miss payments to suppliers, contractors, and banks. Those banks then tighten lending standards, not just for property, but for the entire economy. Credit becomes harder to get. Growth slows, and the feedback loop deepens. This matters to Western markets because global growth assumptions are built into everything from stock valuations to corporate expansion plans. A multinational company projecting steady sales growth over the next decade has often assumed that China will continue absorbing products, services, and investment at scale. When that assumption weakens, future cash flows are discounted more heavily, and asset prices fall today. Western investors often underestimate how psychologically destabilizing prolonged uncertainty can be. A sharp crash is shocking, but a slow bleed is exhausting. China's crisis is unfolding in a way that erodes confidence month by month. New restrictions, delayed data releases, sudden regulatory changes, and selective bailouts create an environment where foreign capital feels uneasy. Portfolio managers don't need proof of total collapse to reduce exposure, they just need enough doubt to justify reallocating capital elsewhere. When large funds rebalance away from Chinese assets, they don't simply move money into cash. They adjust global portfolios, selling related positions, hedging currency risk, and raising liquidity. This process can pressure Western equity markets even if domestic fundamentals appear stable on the surface. Consider global supply chains. For years, companies optimized for efficiency, relying heavily on Chinese manufacturing and logistics. as China's economy slows and policy becomes less predictable. E. Firms accelerate diversification, moving production to other countries. While this sounds positive in the long run, in the short term it is costly. Building new factories, training workers, and establishing logistics networks require capital. Margins shrink, costs rise, and earnings forecasts are revised downward. Investors respond by repricing stocks. At the same time, inflation dynamics become more complex. Supply chain shifts can keep prices elevated even as demand softens, putting central banks in a difficult position. Higher rates to fight inflation increase debt servicing costs, while lower rates to support growth risk currency instability. This policy tension adds another layer of volatility to Western markets already grappling with China-related uncertainty. Debt is the common language linking China's crisis to Western vulnerability. China's leverage is high, but so is leverage in the United States and Europe. Governments ran massive deficits during recent crises, corporations borrowed cheaply during years of low interest rates, and consumers accumulated debt in pursuit of rising living standards. When global growth slows, servicing this debt becomes harder. A shock from China doesn't need to directly hit Western banks to cause trouble, it just needs to slow revenue growth enough to expose how thin some margins have become. Credit spreads widen, refinancing becomes more expensive, and defaults increase at the edges of the system. Markets, sensing this shift, demand higher risk premiums, pushing asset prices down. There is also a geopolitical dimension that markets cannot ignore. Economic stress often hardens political positions. As China's leadership focuses inward to manage social stability and growth, tensions with Western countries can intensify. Trade restrictions, technology bans, and retaliatory measures disrupt business planning and investment flows. Each new policy announcement introduces uncertainty, and uncertainty is the enemy of long-term capital. Western companies caught between competing regulatory regimes face higher compliance costs and strategic dilemmas. Do they invest more in China and risk sudden rule changes, or pull back and sacrifice growth potential? These decisions ripple through earnings calls, analyst models, and ultimately stock prices. For individual investors, this all feels distant until it suddenly doesn't. Retirement accounts fluctuate, pension funds report lower returns, and volatility becomes a constant backdrop rather than an occasional event. This is where understanding market psychology becomes crucial. Markets are forward-looking, but they are also narrative-driven. When the dominant story shifts from endless globalization and growth to fragmentation and risk management, capital flows adjust accordingly. Assets once valued for growth are re-evaluated for resilience. Cash flow stability, balance sheet strength, and tangible assets regain importance. This shift can be brutal for sectors that thrive on optimism and leverage. Precious metals again serve as a barometer of this psychological transition. Gold's appeal rises not because the world is ending, but because the margin for error is shrinking. When trust in long-term promises weakens, investors look for assets without counterparty risk. Silver's dual role makes it a fascinating case study. Industrial slowdown pressures prices, but monetary demand pulls in the opposite direction. Watching how these metals behave during China-related stress offers clues about whether markets are more concerned with recession or systemic risk. The most underestimated factor remains time. China's crisis is not a single quarter event, it is a multi-year adjustment. Each year of slower growth compounds the challenge, especially when debt levels remain high. Western markets can absorb shocks, but repeated shocks change behavior. Investors become quicker to sell rallies and slower to buy dips. Volatility becomes structural rather than cyclical. This environment rewards patience, diversification, and an understanding of history rather than blind faith in perpetual growth. Ultimately, the question is not whether China's $8 trillion problem affects Western markets, but how deeply and through which channels. The connections are already there, woven into trade, finance, psychology, and policy. Ignoring them doesn't reduce the risk, it just delays recognition. And when recognition finally arrives, markets tend to move faster than most people expect, faster enough that by the time the danger feels obvious, prices have already adjusted, leaving many wondering how something that seemed so far away ended up so close. So,